I am a founding partner of Flying Tiger Capital. So we do investment and advisor. It's an investment advisor firm, and with focus in the venture capital investment in enterprise SaaS, fintech, and Web3. So today it's such an honor to have Curtis with us to our Mommy and Money Club guests to talk about how to be your own bank. So it's a concept I've been heard a lot in a lot of conference. I go to a lot of networking events. People talking about like an infinity bank, be your own bank, and is that another name? Is a velocity bank or something
No,
like that?
that's something else. So you'll hear
Okay.
cash flow bank. Velocity bank is where you're using a line of credit and
Okay,
that
gotcha.
thing. That's
Okay, cool. I may mixed up with all those
Bank
strategies.
on yourself, it's that kind of stuff.
Gotcha. Okay, cool. Yeah. So yeah, such an honor to have Curtis with us. Actually, it's really impressive. You are a podcaster and also creator and founder with Practical Wealth. I checked your podcast. You have over 200 episodes. That's really amazing because I've been told if you have over 100 episodes, you have top 5% of all the podcasters. So you have 200, so you must be top 2.5% or something like that.
I like to talk. People keep wanting to be on, and it's a lot of people that need information. So we just try to, our theme is kind of wealth without Wall Street. So,
Gotcha. Yeah, gotcha. So I know you have over 35 years experience in the financial planning business. So without the further ado, I just the floor is yours. Here we go.
Okay. I would say my first, I actually got into financial services in college. I realized the NBA was not looking for 5'11" shooting guards. And I got my insurance license, but I was with a company that specialized in buy term investor difference. So I always say I had 1 year experience 10 times, and then I kind of, I read Rich Dad Poor Dad, and I realized, okay, wait, what we're teaching and what he's talking about are like different things. And I started to, question that, the stock market was the end all be all after living through several crashes. And I read that. I got turned on to somebody named Kim Butler. Shortly after that, I got turned on to this little book called Becoming Your Own Banker. And that started me down the road of Austrian economics and really understanding the Austrian business cycle theory. I mean, I'm a nerd, so I wanted to know why stuff worked, right? And then I got really introduced to a mentor that showed me how to do the genesis of what I'm going to show you all now. And, the rest is history. We just keep getting better. Our family does it. I am a third generation business owner. My grandfather was in business. My dad was in business. I'm from the Philadelphia area. We own a supermarket, and we were in the tavern business. And, my dad actually joined me in the financial services business. So, before he passed away. So it's, I never got that go to school, get a good job talk.
Okay, that's good.
I never got that. My dad told me you never make any money, work for somebody else. So a job was a bad thing in my house. Okay. And so that just a little background about me. I'm very passionate. I'm known as the, let me share while I'm talking. So I'm kind of known as the anti-Wall Street financial advisor. I understand all that stuff. I was a registered rep. I just, the people I work with, they tend to want what I call work optional income. So our emphasis is on, in the financial world, matter of fact, let me show this. There's, can you see my screen?
Yeah, perfect. We can see you perfectly, yeah.
This works, there we go. So there's really two schools of thought when it comes to money. There's the personal finance method where most people are taught, they focus on net worth, get out of debt, invest for the long term and diversify portfolio and mutual funds, buy term investor difference, the rule of 72, modern portfolio management theory. Basically, everybody in financial institution, the goal of the institutions is net worth. But if you took a corporate finance course, Jasmine, you know this because this is how you think, they don't talk about that stuff. They talk about velocity of money, don't they? They talk about cash flow. When you're analyzing deals, that's what you're looking at. How do you manage your risk? How do I use leverage? What I'm going to show you today is a lot of institutions use permanent insurance as part of their strategy. So the first part, I'm going to kind of break my talk into two parts. I'm going to show you how banks make money, okay? And then we're going to talk about the private reserve strategy. They're both just, I call it the private reserve strategy or private family banking, but I'm going to show you a little bit of the economics and why it's important. But at its core, it's a saving strategy. It's not an investment strategy, okay? And so that's what I want to get people to understand. If you like podcasts, real shameless plug, here's the Practical Wealth Show. And, you know, we talk about syndications, we talk about apartment buildings, buying dry cleaners, buying businesses. I've had interviews and, you know, because what I teach people, there's 4 asset classes: business, real estate, paper, and commodities. And so if you're really diversified, you're in all 4. What we're going to talk about today is, so here's the magic question, Jasmine: where do you store your cash? Okay, and that's the question we're going to answer. And how do you manage money like the institutions manage money? And I'm going to show you how to borrow the business model of Bank of America. All right, so let's talk a little bit about, here we go. All right, is my screen showing? Yep, okay. So let's talk about private family financing. So here's Curtis, right? So we help, so part of what we do is, you know, I teach something called principles-based planning. We're not going to cover that today, but what I teach is principles drive strategy, right? And so you've got to have financial principles. So we teach 5 of them, which maybe we have time, I'll talk about those a little bit later. There's strategy, and then there's tactics. So what I'm going to show you today is our key strategy, the private banking, and I'm going to show you a tactic. And a tactic is a product that you buy, but products literally come last. They're not important until you have a plan. But we help clients create and use their own private family bank. Why is that? So they can learn how to get money or to get interest to move towards you rather than away from you, so that you can use this additional cash flow to create generational wealth. See, most people think the key to growing their money, Jasmine, is investing. Everybody wants to chase return. They want to find better investments that pay a higher rate of return. So I want you to look at this in reverse. What I teach people, if you're going to create maximum wealth, you must create maximum efficiency first, okay? Because we have a finite amount of money. And so what you've got to be able to do is we have to stop giving money away. So there's 6 areas where people lose money. And this is kind of how we help people fund their banks. So I look at 6 areas. The number one way that wealth is lost is how people manage cash flow. Okay. So if you all have, it's a book called Profit First, which is life-changing, of when money hits your business or your personal economy, how do you tell it where to go instead of asking where it went? So we have a first thing we do, we work with people, Jasmine, we make sure we know where their money's going, and we try to give each dollar a job and tell it where to go. That's 1. 2 is what we call wealth transfers. A transfer is money that you're losing unknowingly and unnecessarily. So the top 5 are, there's like 20, but the top 5 are how people pay their mortgages. Okay, so 15-year mortgages, trying to pay them off early, bi-weeklies, all of that in today's monetary, the way that the Fed works and all that stuff, that's a complete waste of money, okay? Yeah, a lot of people do it because they want to get out of debt. I'm going to tell you, getting out of debt is not your first objective, okay? So I'm going to step with some toes, I know, all right? So, but you got to, the truth hurts. And so I have to have fun while I do this. So you got to, that's another very silly. So taxes are the number 1 wealth transfer. One of my goals this year is I'm looking to partner with some tax people because I want to help our clients win the war with the IRS. Okay, because there's definitely a war going on, right? And you have to keep more of your money. 3, legally, right? Nothing under the table, nothing gray, just understanding the law. 3 is how people fund their retirement plans, their qualified plans, understanding how they work. There's a lot of wealth transfers associated with that. 4 is how people pay for educational expenses, 529 plans, anything like that. And 5 is how we pay for major capital purchase, which is defined as anything you can't pay for in full within monthly cash flow. All right. So we teach people to look at their personal economy. You know, that you're trying to fill up a bucket that has holes in it. The first thing you have to do is plug the holes first, instead of trying to turn up the volume of the water. So Curtis is the hole plugger guy, just to shortcut what I do, right? So let's talk about family banking. What is private family banking? So family banking is a concept, okay? It's the creation and utilization of a pool of money, okay, or capital that is controlled by a private individual. All right. And the one who puts the money in owns the bank. The one who owns the bank receives the profits of the bank. All right. So it's really that simple. So, oops, that's not, the slide is messed up. Here we go. So how do banks make money? So let's look at Bank of America. So we're going to go into their business model and how does it work. I don't want to mess up this slideshow. Let's see. And there we go. All right. So think of who are the players in the place. So in the banking process, you've got the saver or the depositor, you've got the bank, and you've got the borrower. And so most of us generate revenue from our businesses or get a paycheck, and we have direct deposit into somebody's bank. Let's just say Bank of America, right? So they, so Jazz, let me ask you this. Have we ever talked about the 4 rules of financial institutions? Have I taught you about that? Before?
I don't think so. I don't think so.
So here are the 4 rules. So every financial product sold, here are the 4 rules that govern all financial advice, because basically Wall Street are product manufacturers, okay? Insurance companies are product manufacturers. And here's what they want. And hold this and see if what they want is in line with what you want, which is passive income greater than expenses, right? So if you're a financial institution, you want me to put money in your bank, Jasmine, what do you want? You want me to put money in your institution, right? That's rule number 1. Put your money, give me your money. 2 is, how often do you want me to deposit my money in your institution?
As much as possible, right?
Yeah, every time I get paid, you want to go into your company. 3, don't you want me to keep it there as long as possible?
Yeah, the entire Wall Street system is designed to keep the money in the system, no matter which product you use.
Because when do you want me to get it out? Never, right?
Never.
So
exactly.
Every product is designed, everything that any of these institutions design is with that in mind. So you have to understand that. And so if your goal is cash flow, Goldman Sachs or Merrill Lynch, their goal is assets under management. So if you want to get your money out and do alternative investments, or you want to do real estate, they don't like that, because if you take money out, their fee income goes down. So now I'm not saying they're evil. I'm just saying you've got to know how it works and know from whence their advice comes. All right. And so now let's go back to the banking system. So Bank of America, this is from the Bow report. I got to update it, but this is 2019 Bow report. And as of this, there's a report, you can get all the numbers of all the banks in the country. So Bank of America had $1 trillion in deposits, over $1 trillion in deposits. That means we save money. You know, when you put money in the bank, you're loaning it to them. You become an unsecured creditor the moment you make a deposit, okay? Now, they paid $93 billion in interest to their savers, to their depositors, right? But they loaned out, using the savers' money, by the way, right? Almost $60 billion in interest charges, and only paying out $9.3 billion. So they bought money for $9 and sold it for $59, okay? That's how you have to look at that. So it's all wholesale retail, even with money. Okay, so a lot of people don't look at money like that, like in terms of markup, but look at this. So they paid on average 0.88% to rent your money, okay? And then they loaned it out on average of 5.8%. You're like, well, big deal. It's only 5% spread. No, That's a 660% spread, a 660% markup on the money. Okay, so now, is that a good business model if you can get a 660% markup, right? And so now, so hold that thought, because now how do we incorporate this model into our personal economy, into our business economy? And so that's what we're going to talk about. So Nelson Nash, so one of the homework assignments, I don't even let anybody work with me, Jasmine, until they read this book. So they know if they hear me on a podcast. I had a guy talk to his doctor out of Seattle. Yeah, she says, all right, I heard you don't talk to people until they read the book. So I bought the book. And so I took him through a little bit of a book study impromptu to see if he understood what he was reading. And but Nelson said, I knew him, he passed away like 3 years ago. He says everyone should have two businesses. They should have the one that gives them a paycheck and the banking business, okay? Because we just looked at the profitability. So now let's take this, and then I'm going to shift to a different talk. I wanted to kind of set up to get your thinking right. So let's look at the IBC, infinite banking, or the private banking process. So remember the players in the play. You've got the saver, you've got the banker, you've got the borrower, okay? So I'm going to let the cat out of the bag. I usually show this a little bit later. Banking is, we show people how to use properly structured dividend paying whole life as a storage facility, okay? So we pay ourselves, we run money through the policies. That's us being the saver. Then the bank is actually not the policy. It's a separate account. We take loans. When I take I got a tax bill. I'm taking a loan against my policy to pay a state tax bill because I have the money, but I don't want to give them my money. So I'm going to leverage my money, pay them, pay the thing I'm going to financing, and then I'm going to repay myself with interest and recapture my money. Okay, so that's the process. All right, so now hold that thought, because I'm going to come back to that, and I want to break down the economics of how this works. Okay, so I'll get excited. So I'll talk fast, but I'll slow down. I'll leave time for Q&A. I appreciate y'all staying up. It was 9 o'clock here, so I mean, it might not be that late for you. It's only 8 o'clock, right? And let me see. So now what we're going to talk about is what we call in our system the private reserve. So here is the goal. In fact, let's back up. Let me show you this first. So when I look at people, what I teach people to do is you've got to take a 50,000 foot view and look at what I call your personal economy. So this is your personal economics. So when we work with clients, we can have every conversation about your money on one page. All right. And so what this represents is the money that you will make in your working lifetime, from wherever you are now to, I don't really believe in retirement, but for lack of a better word, I almost say retirement. Okay. And so you're going to make millions of dollars. Okay. So a lot of money is going to flow through your personal economy. So a lot of times what people do is if it's W-2, boom, here's your friend, your number one expense is taxes. The lifestyle regulator is what I talked about, cash flow management. And if you're not careful, Jasmine said most of y'all are really good savers, so I don't think this is an issue. But a lot of times people are spending like 105% of their income, right? So money's coming in, out, and down the drain, or worse yet, they're in debt, right? And they're spending money. Debt is a future obligation in which you consumer debt, right? Not in debt to buy assets or whatever, just buying stuff, is you're spending money you've not yet earned. So you're using future earnings as collateral. Okay, that's what we call debt. And then we got your house. So a lot of people want to pay their house off early. I'm not even, but I do like Saturday workshops where I'll go into different aspects of this. But what we're going to talk about is this. So most people are doing this. A lot of people I talk to look like this. They have a lot of money in what I call the yellow tank or the risk tank, fluctuating in equities. A lot of people don't they discount savings. So they're just not liquid enough, right? And so position A, if we talk about becoming financially free, is being able to live like you want to live from the income from your personally invested assets without a job if you want to. So we call that work optional income. And so in a perfect world, this is what we want. Position A is green tank full, yellow tank full, but our emphasis at Practical Wealth is on cash flow, okay? So when we look at the 4 asset classes, business, when we look at the Forbes 400, how are they on there? They build businesses, they buy real estate, okay? They buy their paper assets. Got clients that do private lending. I've got clients that do life settlements, you know, so those are paper where you get growth. You've got some safety where you've got, you know, an underlying baseline where you can't lose money. But here's one of the other things in the yellow tank. One of the things that we teach is investing is not about buying something. It's about becoming something. Okay. So Jasmine, when we were talking, it impressed me because you've become an expert in private equity, in venture funding, of analyzing, underwriting, you know, figuring out and finding deals. That's an expertise, right? And so for you, that's not risky because you know what you're doing. And see, so as your knowledge goes up, your risk comes down. Most people just want to give their money, which is all right, but you still need to understand it. But you want to become an investor. You know, I've got a client that's become a trader over the last 18 months. So yes, he's in paper and he's, you know, trading options and stock, but it's not risky for him anymore because he's learned how to do it. And so I want people to just not blindly give their money to people. I want them to understand what they're doing. But the way I teach this is principle. The way we teach it, I'm just going to give you a 50,000 foot view. In terms of order, the first rule of wealth is pay yourself first, right? So we say save 15 to 20% or more of your gross income in the green tank where you've got savings. Let me define savings: safe, liquid, accessible, guaranteed. Okay, so you cannot lose money. All right, and so what I teach is a minimum of 6 to 12 months, a minimum of 3 months, but 6 to 12 months of liquidity is your goal for this money, right? And then everything over about 3 or 4 months, you should be looking to buy or build cash flowing assets. And then what do you do with the new money? You save it and then you buy more assets. So we call that the velocity method. That is the corporate financing of getting into velocity of money. Now, here's the challenge that happens with most people that are savers. Most people save, and let's say you want to put money into an asset. How do you get money out of it? You have to withdraw it, liquidate, or what we call drain the tank. And then you put it back in, and then you drain the tank. So are you making any money when the tank is empty? No. Okay. And so what if you could access this money without actually taking the money out? That's the private reserve strategy. So now let me go back and let's get into this. This is only about 6 slides, so you'll go pretty fast. So what happens is the private reserves, the benefits of savings is lower financial stress, as you know. And so the strategy, remember principles drive strategy, is combining a unique type of savings account with a new approach to your major capital purchases, okay? And so the key to the account is the money must be accessible through collateralization, meaning you should be able to leverage the cash without liquidation, all right? And so the 2 key concepts that we try to get people to understand before we get into mechanics is, one is that you finance everything you buy. You finance everything you buy. You either pay interest to use someone else's money, which you all understand, but here's the other part that a lot of people have a hard time getting because they want to pay cash. When you pay cash, you give up the ability to earn interest. So that means you finance it, okay? And you're giving up interest you could be earning. And what a lot of times what we don't count into the equation is a concept called opportunity cost. Now, so let me show you what I mean real quick. So let's imagine You work, you save $500-600 a month over 30 years, and you've accumulated 30 grand, okay, in savings. And you just got a Dave Ramsey class and you want to go buy a car and pay cash for it, okay? And let's say we go to church together. I'm like, look, Jasmine, I don't think that's a good idea. I know you're doing well. I'll give you 100% financing, and you'll be better off if you don't drain the tank and pay cash and finance the car. And I'll ask regular people that are not investors, say, do you believe me? People say no. Okay, I don't believe you. I want to pay cash. But what you have to look at is the difference between compound interest and amortizing interest, right? So amortizing is the money working its way to zero over 5 years. So let's say we finance it over 5 years. So Jasmine, I get hyped up. So you got to tell me maybe I should slow down and not talk so fast. So okay, I'm all right. So what happens is, let's say you had $30,000 in cash in your account. Now I'm going to change the numbers, but let's just say right now they're both earning 5%. And to make a point here, so at 5%, your money over 5 years, if you never added any new money, would earn $8,500 in interest. You would have $38,501. Okay. Now, but if you look at this, let's say you said, well, I'm going to finance it. So what people don't want is this right here, the $566 payment. But if you look at that over 5 years, you pay for the car and your interest cost was $4,000. Okay. But your money made you $8,500. So what did you make out better not using your money? Because if you drain the tank, you don't have this. You definitely don't have this because you spent the money and you don't have anything. You might have a car worth $5 grand. Whereas you could maintain control of your money, use other people's money, and leave this money free to work for you. Okay. And so let me change the numbers a little bit to make it more realistic, because I know people are, what do you get for 5%? So let me show you. We definitely get you 3 or 4, right? In a safe place. So let's say the money costs you 4. No, I'm sorry, you were earning 4, but the money cost you 6. Is it still worth it? Okay. Let's say the money costs you 3. See, the key is you stayed in control of your capital, and this is to buy a expense, a car or something like that. What if you turn around that $30,000 was for a down payment on an asset, and your money was still making money, and now it cost you $580, but it was turning over $1,200 a month of rent for you. That's a whole, and your money's still making money. So what we want to do is, you want to create multi-purpose dollars where you have $1 doing many jobs. So I want you to hold that thought. And I'm going to come back to, I want you to see the power of not using your money.
So that only works if it's compound interest.
Yes, but compound interest works best over time, uninterrupted. So if you keep draining the tank, you can't earn compound interest. Here's another fun fact. Do mutual funds earn compound interest?
No.
No, they don't. They get a rate of return, but mutual funds appreciate and they depreciate. So a lot of people represent it. Well, my fund did over the last quarter, 12.3%, but that's not interest. That's a rate of return. And so only savings vehicles compound. And so mutual funds appreciate, depreciate, they're worth whatever the net asset value is at the close of the market. And so that could change. And so that's why that's a yellow tank thing. I'm not saying not do that, but you just got to accept. A lot of people conflate savings and investments. People think, well, I'm saving in my 401k. You're not saving your 401k. You're investing. If your money's going into mutual funds, you are not saving. But that's the language that Wall Street is teaching you, so that it feels less risky than it really is. All right. And so here's the other thing I like to show people. So there's 3 types of people in the world. There's the spender, there's the saver, and there's the wealth creator. So the spender, or I like to call the debtor, this is the zero line, this is the timeline. So for most people, they earn money, they borrow, and they live below the zero line. And so what they do is they spend their life working their way back up to zero, right? So when people say their first goal, oh, I got to get out of debt, Curtis, it's like, you're just working your way up to zero. That does not create wealth for you. All you're doing is transferring your wealth to the bank. That does not make you money. Getting out of debt, paying off your house early, it saves you money in interest, but you got to ask yourself, does saving money in interest make you money? I'm not even going to answer. I'm just let y'all think about that, okay? And I'll come back and show it to you. Hold that thought. Now, I keep myself from going on tangents. So here's the other part. Here's the saver. So saving is good, but the challenge with saving is nothing I would argue is better than debt. Well, I don't know. It depends. So, but what happens is for most people, saving is just delayed spending, right? You save it, you get what you want, boom, you take it out. You save it, you get what you want, boom, you take it out. And so what's the net result? Zero, right? You just end up back at the zero line. And so with my first 15 years in financial business, all I knew that existed was door number one and door number two. You could be a spender. I just thought it was one of these two things. But when I discovered what I'm sharing with you now, the private reserve, then I realized there was a door number three, which is the wealth creator. Okay. And so we want y'all to be wealth creators tonight. And so the wealth creator, so step one is you have to save. So this first, if you've ever read The Richest Man in Babylon, the first chapter in the book is part of all you earn is yours to keep, right? So you have to pay yourself. So the number one decision that we all have to make is how much of your money you get to keep, and you must pay yourself first. Like, I don't care if you make 30 grand a year or 300, you've got to be able to organize your cash flow so you can save 15, 20% or more of your cash flow, because that's your seed money to build wealth, okay? Which I think you already know this. You're on her call, right? And so what we want to do is we want to keep you living above the zero line. And then the other thing that we try to teach is a lot of times when people pass away, they go back to the zero line. And what we want to be able to do is show you how to build generational wealth, teach what I'm about to show you, and have our next generation start here and keep that going, if that makes sense. So let's break it. Let's look at through the funnel. So you got the spender, right? And so what they do, they have no collateral. So when they need something, the only option they have is to use credit for major purposes. And that's a slippery slope, right? Because you'll just buy more and more, and you can get trapped in what I call the debt paradigm. And then there's a saver, right? So the saver saves money for the future. So they put money or funding their retirement plan. They save extra for current lifestyle expenses. What would that be? College, vacations, a car, a kitchen remodel, something like that, right? And so what they do, what's the major capital purchase? Anything that you can't pay for in full within your monthly cash flow, okay? And you have to finance it. And so what happens is, but how you finance it is a major wealth transfer. So what they like to do is to pay cash to avoid debt and interest. So they drain the tank, that money's gone, but they don't put the money back. So as well, they spent it, they got to what they wanted to do, and they used the money. All right, so great, we didn't incur any debt. So that's only seeing a piece of the economic puzzle. So what we want to share with you, I want you to look at the idea of being a wealth creator. So the wealth creator managed their cash flow. They save the amount necessary to live for today and tomorrow. They diversify their accounts to create access to capital. Number one problem I see as I work with clients is the lack of capital, lack of access to capital, sometimes having access to other people's money, and then just plain lack of capital, okay? And they borrow for purchases using collateralization instead of draining the tank, okay? And then out of their cash flow, they pay the loans and interest from their current lifestyle, or if it's for an investment, from their investment. So here's the strategy in action. You've got money. So one, you're saving money. So now you've got money. So knowing what you know now, you don't want to drain the tank. So you say, all right, I've got this stuff over here I do. I need this car. I got to go shopping. I need to remodel my kitchen. Or I've got this hot investment deal. I want to buy this business. And I don't want to now drain the tank and break up compounding. So I'm going to find a financial institution. I'm going to say, listen, I don't want to use my money. I want to use your money, but I'm going to use my money as collateral. Okay. And so a traditional institution, if they allow this, they will give you an amortizing loan with a payment. They're going to give you a structured principal and interest payment. But that's all right, because what's the power of that? You pay it back and they release the lien against your collateral and you wash, rinse, and repeat. That is the banking strategy. That is the private reserve strategy. So the base level power of that is the power is you continue to earn compound interest on your collateralized funds. So while you're using this money over here, your money is still making money. So I want you to think the example I just showed you with the 30-30. Does that make sense? And so you got to understand that. So it might behoove you to pay interest so that your money can continue to earn interest. Okay. So now I need you to, if you don't get that, you're going to miss all the rest of this. All right. I think you do. So now let's look at where's the ideal place to store cash. So if this existed, let's wave a magic wand, right? And I could give you the ideal storage facility for your cash. Would you want tax-deferred growth? Would you want to be able to get access to your money tax-free? Would you want to be able to earn a competitive return? Would you want to put in as much money as you could afford to put in? It would be great if the contributions could be deductible. You want to be able to use the money as collateral. It was safe. Now, in most states, when I say safe, meaning it's invisible and nobody can sue you to get through this money. So it's creditor protected, lawsuit protected in this account where you're storing the money. That's major. And you can't lose money. No market risk. It's safe. You have a guaranteed loan option. So if you needed money, you have the guaranteed ability to contractually to borrow against it. You've got unstructured loan payments, meaning that you can create your own payment plan. You could stop it, you could start it, you could give yourself a 2 or 3 week bank holiday if your project is held up. It's not going to affect your credit report. Nobody's going to call you. And you just restart once you get your project on the go. Okay. So what if that existed, right? What if the money was liquid? You could use it how you wanted to, and you were in complete control of the capital. And some additional benefits I'll show you in a second. So now, if this existed, would you want to have some money in this account? I can put that in the chat. I need a little audience participation, right? Would you want, here's the way I ask it when I talk to clients. Can you think of any money, if this existed, that you wouldn't want to have in this account if it actually existed, right? And so here's the thing: if while many accounts work as a private reserve, some work better than others. So let's take a look at where people. So it goes back to my original question: what are the benefits that you like if you could get them, and where do you store your cash? So where do most people store savings? Savings accounts, money market accounts, CDs, your mattress, okay, or your cover. And so what happens is, so let's look at the benefits. So should you have this account? Yeah, I wouldn't have any more than about 2 months of my business or personal expenses in a bank. And definitely no more than 250. If you got like $500,000 in banks, you need to split up and buy another bank. So because you only have FDI insurance up to 250. So that's risky, okay? Because they're not going to bail the banks out anymore. The new Dodd-Frank law, not new, but the Dodd-Frank law, they're going to bail you in, and you're going to be owner of the bank, and you're going to own stock, and your money's going to be gone. Okay, so you got to understand what's going on in the world. I mean, a lot of people are, you want to store the majority. What if you could store the majority of your capital outside of the banking system? Okay, but you could move it in and out when you want to, but you stored it somewhere else. That's what we're talking about. Okay, and so where else do people store money? CDs. I'm going to talk about that. HELOCs, home equity line of credit. So should you have one? Yes, if you qualify for one, but it's great to have. This is, Jasmine, when they talk about, it's a whole strategy with the HELOC and paying your bills with the line of credit. That's velocity banking. Okay, I'm not sold on that, honestly, because the question is, it always falls back. Well, who owns the bank? See, I don't own the bank, so that means I'm not getting the profits. That's my major flaw with that. It's like, all right, well, I don't own the bank, and so now, people say, well, 4%, 3%, I can get 8, 10, 12% on my margin account, Curtis. Yes, but the margin account, what if the market goes down and you get a margin call? So if you have that, that's, you want to be able, it's all about leverage, right? But you gotta, to me, the underlying portfolio is too volatile, okay, for that. So I want my collateral capacity tied to safe things that are guaranteed. I like guarantees. I like certainty. People say, well, Curtis, I can borrow against my 401k. Okay. Look at the benefits of the 401k. And so let me add to that. You can borrow up to $50,000 or 1/2 of the account balance, whichever is less. You do not have unstructured payments. As soon as you take a loan out, you've got to start making payments the following week, and you got a 5-year payback. So, that might be, I had a client borrow $40,000 because she bought a house, but her payment was like $450 a week. And so she was paying back $900 a month. So she didn't even realize the profits. I mean, she did get the house and she got the deduction, but it took her a few years to realize the profits from her house because it was eating up all her paycheck. And so it was a mess because she couldn't control the payments. Okay. So now let me show you the last one on the list. Nobody ever guesses. Permanent life insurance. Okay. Properly structured. I'm gonna go in that in a second. You're like, insurance, don't hang up on me. All right, insurance, yes. I think and so what happens is insurance has everything on the list except deductible contributions because it's treated. Well, first of all, I'm not going to say it's similar to a Roth. It's like a rich person's Roth. So some people make too much money for a Roth. And so this is like a Roth with more benefits. But I hate saying it's like a Roth because insurance is over 200 years old. So it predates, life insurance predates the tax code by over 100 years. So it's not a tax strategy. It predates the tax code. Okay. And so it's a contract. It's a free. I tell people, look, would you rather have your money in a joint account with the Treasury Department or in a free contract with other free people? All right, which is a life insurance company. So here's the thing. So let's talk about the private reserve, permanent insurance. I'm sorry, as a private reserve. Then I'm going to give you the 10-minute lesson on life insurance, and then I'm going to stop with questions. And if we have time, I'll do a case study of buying real estate using the strategy. So permanent life insurance. So now we know we got to save money. So again, it's just a savings money. Where does the money come from to do this? You saving 15 to 20% or more of your income and running some of that money through your permanent life insurance. So now what happens is you fill up your green tank. You've got, this is what my clients do. You've got stuff over here you want to do. So instead of liquidating your cash, we're going to borrow the insurance company's money. Okay. They're using so people say, well, I'm borrowing my own money. Why am I paying interest? You're not borrowing your own money. You're borrowing the life insurance company. When you request a policy loan, they loan you money out of their general account. Okay, so they're using your money and the death benefit as collateral. So it's a very safe loan for them. They charge companies I use charge like a 5% simple interest loan. One of them, if you pay it back, they don't even charge the interest until month 13. So if you used it and paid it back within a year, you wouldn't incur an interest charge at all. So I mean, and the payment is mostly principal, right? So it's just a unique type of loan where, and you don't have any structured payments. So remember, you have non-structured payments. Kind of what I do when we coach people, Jasmine, is we help them structure their loan. I had a guy buy a car. It's like, all right, you got to pay. It's not free money. You got to make the payment. Well, how should I do that? How do you want to pay it back? We just got a financial calculator. Say you want to pay it back in 3 years, 4 years. You borrowed 20,000. He says, well, I'll do it in 3 years. So we just calculate it. 20,000 at 6%, because I want you to pay a little bit of interest over and above the cost of money that will drive more capital in your policy. And it was 200 and something, like 325 a month or whatever. And we just set up an automatic payment. And so what does that do? You just keep the money circulating. So here's the thing. Permanent life insurance, when designed and utilized properly, can provide stable growth, cash value collateralization, wrong time, and guaranteed loan access, no tax on the growth, and a death benefit, okay? And there are additional benefits available with policy riders. So that's the private reserve strategies. Let me show you one other thing before we get out of that. Where is it? All right, so let me give you, now I'm gonna give you a 10-minute lesson on life insurance. So when I get done with this, you will know more than most insurance agents, okay? A lot of people don't really understand their product. So think about this. There's a minimum one can pay for life insurance. And there's a maximum that one can pay for the same coverage. So the minimum is set by the insurance company. Guess who sets the maximum? Somebody chat and give me a guess. All right, bunch. Or unmute and tell me who sets the maximum.
I guess you can set it, but it cannot exceeding the guidance amount.
Yes, but who determines the maximum that you can pay for life insurance?
IRS.
The government.
Right.
Okay. And IRS, yes. Thanks, Jerry. And so what happens is and so there's an infinite amount of premium between the minimum and the maximum. So here's what happened. In the 80s, the government, the 1987 to be exact, decided to pass laws, hear this now, limiting how much one could put into a life insurance contract. Now, why would they do that? The reason was not to allow life insurance contract to have an additional advantage over where the government wants your money to go, which is where? Traditional qualified plans. Think about that. Qualified by who? The government, all right? And so here, where we're looking at, let's break this down for a second. So here's the similarities between qualified plans and insurance. So with a qualified plan, IRAs, 401ks, SEPs, 403b, solo 401ks, traditional, when it go in pre-tax, not the Roth. And so what happens is qualified plans go in before tax. There's limits on how much you can put in. The money grows tax deferred. All the proceeds when you need to take distributions are 100% taxable. And there's a 10% penalty if you need to access your money before 59.5. So now life insurance is paid with after-tax dollars. There's no government limits on how much you can put in. The money grows tax deferred. There's a death benefit because nobody gets out of here alive. So don't die for free, okay? And I have a show called that somewhere. And don't die for free. I'm gonna make that a book. And so you receive a death benefit tax-free. You get access to your policy, your account values through loans. And guess what? You don't pay tax on loans either, okay? So now let's look at, so there's the policies above, and this is what Jerry was talking about, above the maximum allowable contribution by the federal government are deemed to be modified endowment contracts, requiring the policy to be treated with the same rules and regulations as qualified plans. Okay, so one of the reasons, if we have time, I'll show you an illustration why you can't do this, why it doesn't go in dollar for dollar when you do this, is because the government requires that there's a certain amount of insurance there, but it still works out in our favor. So let's talk about qualified plans real quick. Let's talk about what they do. So they really do two things. They defer taxes, and they also defer the calculation of those taxes. Okay, and so what you have to ask yourself, or the more accurate word is, they postpone taxes. Okay, because the taxes still got to get paid. So if they're postponing them, then you got to ask yourself two really important questions. The first question is, what tax bracket will you be in when you withdraw the money? Or let me ask it another way. Do you think in the future, will taxes be higher, lower, or the same? Okay.
I think it's higher.
Yeah. Well, we already have administration that wants it to be higher. Okay. So you got to look at that and look and read the tea leaves. So you got to protect your money. That's what I mean by winning the war against the IRS, right? And so it's going to be higher. We think, if we have time, I'll show you the U.S. debt clock. If anybody's on the fence, just look up usdebtclock.org, and you know, even if you can tax everybody 100%. There's not enough money to pay the national debt off. So, or what we're spending. And so the second question is, what deductions will you have when you take the money? Okay, because if your business is sold and you don't, all your money comes out as ordinary income, which is the highest tax. So let's assume, as we wind down, you want to purchase $500,000 worth of insurance. Okay, and the minimum payment is $500 a year for that $500,000, and the maximum you could pay or put into a policy without it becoming a modified endowment contract is $10,000 a year. Okay, so this is kind of a trick question. I'm going to tell you up front. Which premium option looks best? Right? And so most people are saying, well, $500. Okay. And so the lowest premium is called term insurance. Okay. And term insurance is fabulous. There's nothing wrong with term insurance. The problem is it only has one benefit. It's called a death benefit. And so, the best way to win this game is I told people, come to my office, let me write you up a policy and get hit by a bus when you leave, and you pay $500, your family gets $500,000. You win. Not really. Okay. That's not what you want to do, but and see, the problem with term is less than 2% of all term policies ever pay a benefit. Okay. Not that there's any wrong with term. We do tons of term, because the other thing you have to look at is what we teach is something called your economic life value. So let's say you're 42, take your annual income and multiply it by 20. That's how much insurance you're supposed to have. That's how much the insurance company will let you have, right? If you're under 40, they'll give you your annual income times 25. If you're over 50, they'll give your annual income times 15, right? So most people I run into are underinsured because nobody ever explains to them the concept of economic life value. Okay, because insurance is not to bury you. You cannot leave people rich with insurance. That's a whole other talk. But so you need term. There's nothing wrong with term, but the reason that it never pays a benefit, because if you get a 10-year term or a 20-year term, what happens is in year 21, you got to renew it at what's called your attained age. That $500 a year is now $5,000 a year, and you drop it. There's whole organizations that teach you buy term and invest the difference. And when you have enough money, you don't need insurance anymore. Okay. Or what I call the myth of self-insurance. That is nonsense. Once you understand estate planning, that is utter nonsense. Okay. And I'm embarrassed. I taught that for 15 years. Right. And so you think about this. If you had your home paid off, would you drop your homeowner's insurance? No. Okay. If you had, let's say your house was worth $500,000, you had $500,000 in cash, and you had your home paid off, and you had the cash that you had set aside to cover expenses or whatever, would you drop your homeowner's insurance? No. Okay. And see, so what's the difference? I just explained this to my client the other day. She was 67. She said, I want to drop my insurance. I was like, wait, you want to do what? You're 67. What's the odds are between, I had to go here with her. I was like, what's the odds of you pass away between now and 100? 100%. Okay, so why would you drop your insurance? Well, my kids are grown. If she was in my office, I'd have smacked her in the mouth, but no, I'm just kidding. And I'm very passionate about this, guys. So what happens is, it's like you gotta, because what happens is, if you have the insurance, that frees you up to use your money, because you have the insurance, you transfer the risk to the insurance company. So it gives you permission to spend. So it works the same thing with life insurance. Now, let's look at the other side of it. Let's forget about insurance for a second. Let's talk about benefits. So this is going to look familiar. So when you're looking for a place to store your cash, that's what we're talking about, and you can wave a magic wand, this looks familiar, what would you want associated with your money? All these benefits that we showed you before, right? And so that's what you get with permanent insurance. But what happens, so now let's get back to life insurance, right? So when you hear life insurance, most people tend to think getting the most coverage for the least premium, but that's not how you structure this. So a lot of people, when they hear about permanent insurance, oh, it's expensive, it takes 3 or 4 or 5 years for you to get any money. That's not how you design these. We literally solve for how little insurance would the IRS let us get away with as per their rules, right? And so what we re-engineer them, and we focus on the living benefits. So we tend to focus on minimum death benefit, maximum cash right under the government limits, the MEC limits, and we create what we call maximum efficient contracts. And the only benefit the coverage does not exist is deductible contributions. So all of the money over the cost of the insurance is treated like this. So now, what savings vehicle do you have that have these kind of benefits? And so that's the engine that drives the strategy. We show people how to store their cash in properly structured permanent insurance as a storage facility, because the banking strategy is not an accumulation strategy. So when you're asking me about rates of return and can I retire off this, you're back into the accumulation theory, right? And we teach velocity. So it's what can you do with this money to make money is what you have to be thinking about. Where am I storing cash until I can access my capital to use it for something else? So Jasmine, I'm gonna take a break. I'll pull up, I have a quick where I can show you a real estate example, but I want to take a breath. Is there any questions, or you want something you want me to talk about? And if we have time, if we have time, I'll show you this other case study.
Yeah, we can do case study.
So what I want you to do,
or you want to take question first?
Both. I'll pull it up, and if there's any questions, we'll talk about it.
Yeah, let's do that.
Because what I want you guys to do is, when we get done, I want you to reach back out to Jasmine. We're going to work together on this, but she's going to take point on this, and then we'll talk about it,
yeah,
together.
I think, I know this about a year ago, right? I always feel like why this works, a certain policy and certain company works. Like, I think tonight I finally get it, is a non-stop compounding interest. Even the interest is lower, then you have to be non-stop compounding. Otherwise, the strategy not going to work.
Right, exactly. It's the uninterrupted compounding is part of the key, and then the banking part is now managing the money. So let me show you. All right, here we go. Okay, so let's say this is an example of a property. So let's say we got a property, $200,000 property, $5,000 closing costs, total purchase price $2,005, $205,000, right? And This is assuming you pay cash, so no monthly payment. So your ROI is 16% because you're going to get you're renting it out for $2,500. That's a cash on cash return of 16, a little over 16%, right? And I don't really calculate appreciation, but okay, let's say you appreciate 3%. Then in what do we do this in? 120 months, the future value of the property is worth $269,000. So that's paying cash. So that's called 100% financing, right? So that means you drained the tank to buy this house and you're getting back your money in $2,500 a month increments. So that seems good, but you're out 200 grand. Okay. And but that a lot of people, oh, I pay cash, because some people just have so much money. They don't really. I have a guy, one of my clients is the biggest real funeral director in Philly. He does this routinely. And I just can't get him to sit still. So, dude, you're wasting so much money. And so this is what we're looking at. So now let's take it another level. So now what if you said, well, all right, I'm going to get a down payment, right? And I'm now going to borrow $40,000. I'm going to put $40,000 down, and I'm going to get a loan amount for $160,000. So now you've got a loan payment of $1,056. So those are your expenses. You've got gross rental income of $2,500 still, and your net monthly expenses, net monthly income after expenses is $1,400 a month. So you got $1,900 in income, net monthly cash flow. So I don't even care about the appreciation. What I want to look at is this. So just with a little bit of leverage, your ROI on that property went up to 41%. Okay. So now let's look at banking. Okay. So now what if you had money in your green tank that you leveraged? So all of a sudden you took, instead of draining the tank, right? So same property, you're going to still get a first lien mortgage, but now your bank, you're going to borrow, use the insurance company's money, and you're going to come up with the $4,000. I'm sorry, $40,000 from your banking system. Okay. And so now what happens? So let's say you just created a 200, because you remember you got unstructured payment. So let's say you structure a term back to yourself for 240. So now you got a 240 months, you got a $264 payment back to where? Your banking system. So now you've got a total payment of $1,320. You still got gross rent of $2,500, right? And then you're netting $1,100 a month. And so now your ROI is, it's really infinite. Okay, I got to recalculate this, but let's say 370%. Why? Because the 40,000 did that. Whose pocket did the 40,000 come out of?
Insurance company.
Insurance company's money. So you're in. So I forgot to put the slides in. I'll show you your money. Let me show it. So that's it. So, but now here's the other side of that. It's in a different slide. Let me see. I can pull this up real quick. Where is my other presentation? No, let me do it here. Hold on one second. Right. Okay. So let's look at there it is. Okay. So if we had 40,000, who's turning for a 12? What is that? 5 years? 60? No, 240 months. Why can't I count right now? That's I'm going blank. Yeah, 20 year. Okay, so 20 year. I wouldn't do it that long, but let's say you did that. So if you did 40,000 and you paid yourself back over 20 years back into your policy, and let's say you're earning 4%, that's not right. Hold on. No, it is right. Okay. So the 40,000, not counting the money you put in, right, that's right, because I'm doing 20 years. That 40 would grow to $87,000. Remember, because you didn't withdraw it, you collateralized it, right? So it's still in the policy making money. That's what you're talking about, Jav. That's the power of your money can be working in two places at the same time. And so you can use it without using it. And while it's still in there, because when you borrow insurance company's money, most of the companies will treat your money as if it hasn't been touched. And because it technically hasn't, because they loaned you their money. So that's kind of some of the economics that are going on. Listen, Nelson Nash, I'm going to do a boot camp on this in about 2 weeks called a challenge. Because what I realized, Nelson Nash, when he taught this, he should do a 2-day, 10-hour workshop on this, based on going through his 91-page book. So really, and I appreciate your attention. We've been going about an hour, and I've only scratched the surface. It's simple because it's just at the core saving strategy, but there's a lot of economic thought going on in this thing and the misnomer is it's really not being your own banker. It's really being your own money manager, because it's really just a system of cash flow management at its core, right? And so we're just using the features of a properly structured insurance company as a place to store cash, because the way the contract works, it's like a trust agreement. So the contract states, like with an insurance company, if you're not using the money, insurance company is building malls, maybe not malls, that's not a good example, but they're buying treasuries. I mean, the insurance company operates like a really conservative bond fund, right? They buy businesses. And so what happens is they have to put the money to work so they can pay their claims. But your contract says that if you request the money, you take first position. They have to loan it to you. Now they need to charge an interest because they have to make up for not having the money invested so they can meet their claims, right? But they give it to you and you pay it back. But guess what? I want them to charge an interest because we only use mutual companies, and mutual companies pay dividends. Dividends are a return of capital. And so they're all very profitable. So at the end of the day, we paid our salaries, we paid, the death claims, we had good investment performance. Okay, we're going to hold some back in reserve, and we're going to declare a dividend. And the way we structure, and we use the dividends to buy even more savings. So there's a lot of stuff going on. And so reason we like them, because we're both on the same page. They're not trying to chase quarterly stock reviews. They think in 100-year time blocks, and we're owners. So we're all on the same page. So that's why we use the companies that we use, because we want mutual companies. And, the thing is, the 3 rules of banking are from Nelson's book. Think long range. Don't be afraid to capitalize. That means you got to put money in. Okay. You got to pay a premium. And then don't steal the peas. When you read the book, it's an analogy in the book, but basically pay yourself back. Don't steal from your banking system. Don't not pay the loans back with interest, because the interest would drive more money in your policy. So with that, I'm kind of done with the formal part of my of our talk tonight. So I'm hoping that gave you a good, you don't know it all. I will give you some homework. Okay, I'm gonna give her some homework to give you all to do a little bit of reading on this stuff. But any questions from anybody in the audience that I can answer for you? Was this helpful? Am I crazy? Did I confuse you more than?
Yeah, thank you, Curtis. Yeah. If anyone have questions, you're welcome to just unmute yourself or just type in the. Jerry has a question.
Yeah, Jerry, the dividends that's a proprietary. We don't know. I mean, every company calculates them differently. So that's a proprietary number. So we don't know. I mean, a lot of them, the rates, let me show you something real quick. Let me see if I can pull this up. So they're a little bit different because they went through the whole industry went through when President Trump left office, the insurance companies went to the government and said, listen, if you're going to still do this crazy zero interest rate stuff, we can't survive in a zero interest rate environment. So you've got to allow us to have a little bit more flexibility in how we charge, and not repping a company. I just get a chance to take this off. But what I want to do is show you when I talk about a properly, am I sharing? I'm not sharing, am I? Hold on.
You're not.
So they were, a lot of them were like this, but when I mean properly structured, I mean structured to hold cash, right? So a lot of people will see a permanent insurance and they'll go, well, I don't see money for 3, 4, 5 years, but the permanent insurance, so this does include the dividends. It says non-guaranteed. The dividends don't set the world on fire. So it's not that huge a deal, at least not early on. But the premium, so what you're seeing here is premium, cash value. So it doesn't go dollar for dollar. This, the insurance, the IRS says have to be there. And here's the cash value, but they changed the rate, so it's a little not quite as aggressive as this right now, but it's still pretty good, right? So, but in this situation, you put it, your premium was 10, it goes up by 10. It works better with women, at this age, are very super efficient, right? And women live longer, so insurance companies like them. And but not that bad. But it's what happens is, what I want to show you is the premiums become a deposit. Okay, so stop thinking, well, it's going to be a long time before I get any money in there. You can dump in lump sums. I've had clients where we structured it where they dumped in 100,000 within 3 months. They had 100,000 in cash value, and this guy was a private lender, and he was able to, he's borrowing it from the insurance company at 5, loaning it out to real estate investors at 12 and 15%. That's a hard money lender. So it's really your imagination of what you can do. Your insurance amount goes up, but what people look at with the dividend rate and what kind of interest rate, it doesn't matter. Those are all, see, again, what I like is like they can print out, if I do this, I'll have this. So I know what my money's going to look like. Okay. And so this is not going to make you rich. What's going to make, now you can put a lot of money and it'll do all right. But what the point is, this is your banking system. So what can you do if you have access to this kind of capital where you can access it with a phone call or a fax and have it in your account in 3 days to do what you have to do without asking for tax returns, without, if you want to fund a syndication deal, or you want to, put money in one of Jasmine's deals, boom, if you've got your capital storage, you can get it deployed in days to do whatever you want to do, have it in whatever you're investing in. It might be doing XYZ return, but still have it in here making money. And guess what? It's growing tax-free and it's life insurance. So now you've got the same dollar doing 3, 4, 5 jobs at the same time. So that sparked another answer, Jerry. But basically, yeah, there's like 2,000 companies, but there's about less than 12 that you can do this strategy properly with, that are mutual companies. And then that's kind of like their secret sauce. So it's like FICA won't tell you how to calculate their credit scores, the 3 credit bureaus. That's kind of how the insurance companies are. They don't really tell you. So we don't know. Yeah,
we got another question from Edward. It's pretty good concept, but why Susan Allman always recommend only term life and no cash value life insurance?
Yeah, I mean, like I said, it's not the product, it's the strategy. So all of my clients usually get both, right? So term insurance, like I said, it's great, but what if you don't die, right? So remember, who's giving you that advice, right? So what are the 4 rules of the financial institutions? So why would they want you to buy term and invest with difference? Because they want as much money as possible going into their institution so they can charge you fees for 30 or 40 years. But like I said, term, only 2% of term policies. I do not recommend IUL as your own banking system. No, I do not. And that was the other question.
Yeah, I thought about that one. Like I was thinking about why cannot, because they also have participating loan. I guess we're missing.
You can actually. So here's the thing. I don't. Okay, because I like guaranteed. So there's nothing in a universal life guaranteed. So you can get better
No, I think the
performance.
key is compounding interest, non-stop compounding interest, because
Right. You don't get that with
IUL,
UL, because if you have a 0 year, you don't get uninterrupted compounding. I'm not saying you shouldn't get it. It doesn't fit with my practice and what I teach. And I don't think it's appropriate. Nobody that's a hardcore infinite banking uses IUL. The IUL is a more of an accumulation strategy, and it's more of a Roth IRA alternative. Is a tax-free retirement. That's more.
Yeah,
so
I think your strategy is more like alternative for savings. Instead of putting money into the banking's checking or saving account, use your strategy. Like IUL, like you said, it's more like an accumulation strategy.
Our strategy.
Oh, our strategy. Sorry. I'm still learning this strategy. That's why I heard about this, a year ago. A guy was talking about it on the stage. I'm like, it's interesting. Then I'm like, why you cannot use IUL? Because I'm very familiar with IUL.
I mean, people use it, but people that are really teach infinite banking, they don't use it. Matter of fact, when you're going through the practitioner program, you literally put your hand on the Bible that you won't sell IUL.
Really?
So, yeah. Now I'm exaggerating, but not by much. Okay.
On YouTube, there's two sides debating about this topic. I'm just gonna. I don't think it's a compare apple to orange.
That's the thing.
They're
apples and oranges. They're different because they're built on different chassis, right? And so going back, let me finish to make sure I answer the term question. So a lot of experts do that, but what you got to do, so there's nothing wrong with term. I sell tons of term insurance. Everybody I do business with, they all get term insurance, because if I'm looking at your family and you're supposed to have $2 million of protection to protect your family. And if you, let's say, Curtis, I can save $2,000 a month in this strategy, that might buy you $400,000 worth of death benefits. So now I've still left your family underinsured. So we always do term insurance, okay? But here's the trick. I only do term insurance with a company. See, all the companies I use have good term, but it's convertible. So I can convert it into what I just showed you without you having to retest and requalify. And so most of my people, it's like we lock in. I don't know who NYL is. I don't.
New York Life.
Oh, no. You could use both of those. Those are both great companies. I don't. Mass Mutual's good. New York Life has good products. I don't know. There are a lot of their people know how to use it.
I know some companies do not allow the be on bank concept. The ban.
Yeah, Northwest Mutual doesn't. It's a mutual company. They don't like it. They actually penalize their agents for using it. I've got a company that we both know, not wild about it because they're very IUL focused. So you can't take a policy loan for 12 months. That's not the worst thing in the world. Because I have 2 policies with them, and after the 12 months, I literally borrow money from my mobile app and just sit. So if you don't need it right away. So I have other ones where I can get money out right away. So it depends. So this is where we get into. Because if you go to my YouTube channel, we break down. I have a video with my partner Kyle Christensen, and we talk about the 3 types. We try to be very, non-biased. He's a little less unbiased than me, but if you break down the 3 types of insurance: term, whole life, universal life. They're whole life, universal life. Yes, they're both permanent strategies. Yes, they both have borrowing features. But the chassis of how they're built is different, right? Whole life is certain. Everything is guaranteed. It literally becomes more efficient the longer that you have it. Term insurance gets more expensive every year. So if after the term, the price goes from here to here. So universal life is built on a term chassis, right? So that means internally, the cost of the insurance is getting more expensive, right? So if the market or the index doesn't do what is projected, see, these are just projections, okay? This is just projection. And so what if it doesn't do that? Well, you got a rising cost, you've got of insurance, you've got the money may not have done what you hope it does. And let's say you take loans out and then you stop putting new money in, but now you've got rising interest costs. You're not putting in new money and you got a rising insurance cost. I mean, to me, I view that highly risky. I would be terrified to do that. So to me, that's a lawsuit waiting to happen. So I don't do that. Okay. I don't even tell people that you're going to retire off of the life insurance. I told people, look, I want you to develop asset-based income that you don't have to work for and you can't outlive. So I don't view any product as the end all be all. You need to buy or build assets, businesses, real estate, cars on Turo, whatever, right? That will give you the income you need. You can use the insurance as a supplement. We use the life insurance or the green tank as a volatility buffer to protect your yellow tank against volatility. So let's say you love the market, market's down, you need some capital. You can now go into your green tank, leverage it without having to liquidate your yellow tank, sell the shares and pay penalties or taxes or capital, whatever's going on there, depending on where it is, it's qualified or not. So there's it's strategy. It's never the product, it's always a strategy. So it's not term or whole life. The correct answer is both. Right. And the people who talk about that, let me see, I'm looking at the question. What is the percentage number you would recommend for that? It's not a question of asset allocation. So you want to look at, when I look at liquidity, let's go back here. In fact, let me show and tell, my goal for liquidity, can you see my screen?
Yeah.
Is it 6 to 12 months of your income in liquidity, right? And so the first 90 days, if somebody has a business, maybe 6 months, but if you have a job, 90 days, 4 months or so is your emergency fund. And then everything above that number, in my mind, is your opportunity fund, which is now you can go ahead, you can collateralize your safe tank for expenses or for opportunities. And so everything above that then is fair game for you to collateralize that or using other people's money to buy or build assets, and that's what you want to do. So the goal is that, if you got a lot of money sitting where it doesn't have all those benefits, then there's ways to, get lump sums in there. I try to generally, what I want people to do is, let's say somebody's making 200 grand a year, then, 20, let's say 15% of that, 15% of that a year is, could you save $30,000 a year, okay? As a percentage of your income that you might say, well, all right, I think, and you might already be doing it. So then it's just a matter of, let me change the address on some of that money so I can redirect it so where I can build my collateral capacity, meaning money I have available to use, as collateral to do other stuff. Because right now, only way to access a lot of the capital that we have is to drain the tank. And so, Rome wasn't built in a day, right? So I tell people, look, I won't let people be too aggressive initially because I want to make sure they get it. I won't let people do it if they haven't read the book. And we discuss it and I make sure you're clear because this is not, I don't really tell people what they should put in. What are you comfortable with? And I'll show you some numbers. And then what we'll do is we'll do terms. So most of my clients, their future is bigger than their past. So every year we are looking at because we review it every year. So we look, all right, well, I just bought this apartment building. My cash flow went up by such and such. Hey, can we get another one of these? And we'll just convert the term over. So now with 3 days, we can convert the term and we create a new one. Jasmine, every month I convert 1 or 2 policies because the people I'm working with they're doing cash outs. They've got other stuff going on. They say, all right, I got to store this cash somewhere. So they don't see it as life insurance anymore. They see it as a place to store cash.
Yeah, I know.
And so once they make that switch, I know I got them. Yeah. I got clients with like 15 policies.
Yeah, I see some people use this really as their saving account. It's quite interesting. That's why I feel this concept is really interesting because I know Chinese community is a big savers, right? So at least I didn't see anyone is teaching this or doing this in our community. So I was wondering, maybe, yeah, that's why I invite you over to give us, sharing this strategy.
Well, I'm going to teach you how to teach it.
Yeah.
So, any
I'm
other
just
questions? Those are
curious.
great questions. So hopefully, I'm not. I might be getting along with that. Would you recommend premium finance? No premium financing. Not for this. That's a different strategy. I think this is a savings play. I know people that do premium finance is more of an IUL thing, and I know people that do it. It depends. I try to do work with the. So the question was, if y'all can see the chat, would you recommend premium financing to purchase permanent life insurance? We don't. I get it. I was at a conference last week. Hey, then people talk about premium financing. I see very few of them, but for this strategy, it's a specialty, right? For business insurance and for people with a lot of capital. And I still, and honestly, I don't completely understand it, but right now for the clients I'm working with, it's not a thing. It's not, something that, that I find that's especially for the banking strategy is something that you do. So I've talked to some even more experienced practitioners than me, and they're not really that. None of them do that.
Yeah.
Very good question.
Anyone have other questions?
Thanks, Jerry.
Yeah, I guess it's getting late as well. So thanks, Curtis, for coming to share the strategy with us. I'll definitely keep in touch. If anyone interested, either reach out to me or Curtis directly and just learn more about how the strategy works.
Check out the Practical Wealth Show, and you can go to our website, practicalwealthadvisors.com. If you can email me, I guess, Jasmine, Kurt May, I'll put it in the chat. Kurt May at gmail.com. And I have a little book called Live Your Life Insurance, and I'll send you a couple of resources I think might help you, get you on the road to kind of educate yourself on the concept. Because there's definitely a difference in the types of insurance, but people that do infinite banking are very, 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 very pro whole life. So the
yeah, infinite banking is another name for the be your own bank, right?
Yeah, well, it's the book, Infinite Banking, or IBC, Infinite Banking Concept, is the origination of the strategy based on the Nelson Nash book, Becoming Your Own Banker. Y'all can see this. Oh no, I got my little thing up. Wait, where are you at?
Yeah, it's blurred in the background.
There it is. Okay, there it is. Okay, Become Your Own Banker. And my book is bound. It's autographed by Nelson. I've had it since 2010. And if I showed you, I got written in the margins. I added extra pages because it's kind of like a journal. And you study this stuff because it's really studying economics when you really get into it. So it's fascinating. And, and so we try to get people to think about, I try to get people to think from a macro standpoint, because you got to know, Nelson used to tell me, if you know what's going on, you'll know what to do. And, I started to study economics in one lesson, and the creature from Jekyll Island, and just really understanding the play. Bailout is the name of the game. And so how do we, and this is the point, how do you get on the side of the Fed? How do you run their play? How doing what they're doing? So you keep doing all the business stuff you're doing, but what about getting control of the financing? That's what it's about. I mean, it's not about rates of return. It's about, I need liquidity, safety, use of money, and I want certainty. I don't need the policy to do backflips and, all returns and that kind of stuff. I just need a safe place to store cash, because I'm going to make my money in my businesses. So anyway, that's my story. I'm sticking to it. And so there's my email, kurtmay@gmail.com. Let me know. I hope this was, thanks for having me on, Jasmine. So hopefully I
yeah, welcome. Thanks for coming. Yeah, it's I definitely learned a lot and have a better understanding of why, because I keep thinking why IUL cannot do it, because all the features IUL actually have that. Then I realized it is about compound interest, like
So a lot of people sell
non-stop
IUL.
compound interest.
Yeah, so a lot of people, that's what I mean. If you're looking on, I actually question Jerry, that they'll look at it, but one, that's maybe all they have. Two, they actually make more selling it because the insurance companies love IUL because it transfers the risk. Since nothing's guaranteed, all the risk is transferred back to the client. See, whole life is guaranteed, so all the risk is on the insurance company. So they're trying to de-risk themselves. Okay, if you check out my podcast, it's a great show I did with, it's a great book called The Pirates of Manhattan, where he breaks down, Barry Dyke breaks down who owns what, like banks and like Bank of America, they store the majority of their tier 1 capital that regulation will allow in life insurance. They buy it on their executives. That's where they store their savings. Okay, so if it's good to say, if it's good for the goose, it's good for a gander. So now the question, last question, I'll answer Jerry's question before I go. One more question. For the whole life policy you recommend, does it have a fixed loan rate on the contract? So actually my favorite company does both. Okay, so you can choose a fixed or a variable loan. You can choose direct or non-direct, was the other part of your question, I think. Recognition on a loan. So you actually get to pick which one you want, which is kind of unique and it's very nice. So you get to pick.
Got it. Cool. I think it's getting late. And I know you are in.
I can talk about it. It's always 10 o'clock here, but now you got me excited. But I
know you're very passionate about this topic.
Yes. So this is fun, but listen, if I can help, hit me up, and we'll work on it together. And so it's really just a question of, what we'll do. I'll kind of give you a call to action. What we will do if you like this is we try to help people analyze their situation, their cash flow, and their goals. All right. Then we apply for insurance. We're going to apply for your maximum human life value because it's easier to come down and to go back up. You might not accept it all. Let's say you qualify for $3 million, but you might apply for it, but you say, well, all right, I just want to save $1,500 a month. Okay. And I want to do X amount of term. Then we won't accept it, but it's better to get approved for it. Right. And what you'll find, give you a little short 4-page questionnaire. We like to look at your cash flow, and then Jasmine will help you get started with that. So that's if you want to do that, reach out to her. All right.
Yeah. All right.
So good night, everybody. It's getting late.
Thank you everyone for joining. Have a good night.
Half the call.
All right.
Have a good night. All right.
Bye bye.